can't buy. It resides between my eyes. Walked through the fire, came out better on the other side. See, life's like a beach if you find the sand. And right now, I feel like 100 grand.
You are listening to Inspired Insider with your host, Dr. Jeremy Wise.
Dr. Jeremy Weiss here, founder of InspiredInsider.com, where I talk with inspirational entrepreneurs and leaders. Today is no different. I have Chad Olesen of AVRL. You could check him out at avrl.io, although there's not much on the site, and he'll talk about why, and we'll pull it up at some point too, and he'll go through it. Chad, before I introduce you formally, I always like to point out other episodes of the podcast people should check out. Since this is part of the Top SaaS series, some other good interviews there. One of the co-founders of Zapier. That was a very interesting interview with Wade Foster, and he talked about, just kind of the evolution, the journey a bit, which we'll go through with Chad too. I don't know if I would compare this. You're like the Zapier of logistics and freight, but it's some there along that lines, and we'll get into what Chad does in his company. I also had one of the co-founders of Pipedrive on. I think when I had him on, they were 10,000 customers. Now they're at over 100,000. So they've grown quite a bit. And the founder of Mailshake, who's been kind of snatching up and buying smaller SaaS companies and rolling them into their portfolio, that's an interesting story of like growth through acquisition. And I think they have over like 70,000 customers with Mailshake, which is a cold email campaign. So check that out and more on InspiredInsider.com. This episode is brought to you by Rise25. At Rise25, we help businesses give to and connect to their dream relationships and partnerships. We do that in two ways. One, we're an easy button for a company to launch and run a podcast. We do the strategy, the accountability, and the full execution and production. Number two, we're also an easy button for companies gifting. So we make gifting, staying top of mind to your clients and partners, prospects, easy, seamless, and affordable. All you have to do is give us the list of the people, and we'll do everything else. From gift selection to the card to the brand, your branding on the box. Chad, we call ourselves kind of the magic elves that run in the background to make it stress-free so companies can build great relationships around their business. And for me, I found no better way over the past decade to build relationships through having the people I admire in my podcast and sharing with the world what they're working on and sending them sweet treats in the mail. So you can go to rise25.com or email support@rise25.com. I am super excited to introduce Chad Olesen and his team. Chad and his team launched AVRL in 2017 to connect disparate systems for Fortune 500 companies. And we'll talk about, they went through different niches along the way, right? They didn't just land on freight, like the magical moment of product market fit in the right market. So we'll talk a little about the journey. And by 2018, AVRL was working with most of the Fortune 10, and it secured 2 rounds of funding from extremely notable firms, including SAP, Social Capital, Fontanellis Partners, and Morpheus VP. And today, leading 3PLs and asset-based carriers leverage AVRL's technology to automate and execute these disparate systems. And AVRL is currently 496 on the Inc. 5000 and one of the fastest growing companies in Austin, Texas. And fun fact about Chad is he grew up on a farm in a small town. I think this small town is maybe around 1,400 people. So if you can kind of visualize that, it's probably, for some people, Chad, that's less than like their graduating class of their high school, but that's the whole town. So Chad, thanks for joining me.
I appreciate you having me on.
Let's start off with AVRL and what you do. I'm going to share my screen and share the content-rich website of AVRL. All right, and you'll talk about, what do you do?
So at AVRL, a lot of third-party logistics companies, or freight brokers is what the industry calls them, or asset-based carriers, the trucking companies, use our automation to automatically price their transactional freight. Most people in the world don't understand that these asset-based carriers and brokers work on 2 types of contracts. One is an RFP, which is how much volume you'll move on an annualized basis. And then there's another set of volume that trades on almost like a dark pool, but it's called spot freight. And we automate about 25 million transactions per month on the transactional spot side.
So we're looking at the site. People can see this. This is it. I can't click anywhere else. So if you're listening to the audio, check out the video part. And obviously, you probably put a lot of thought into the specific copy on this page because there's only, one, two, three, four, five lines on this whole page. So talk about the thought process behind this.
Yeah, so pre 2020, mid 2020, around COVID, we were operating outside of freight, the logistics industry, and we had full website, et cetera. The moment that we moved into the freight technology space, we had a website, we were talking about what we were doing, and it was probably like 2 weeks later, another freight tech company said that they were doing the exact same thing. And as we started to look into that market, it's really incestual space. There's not a lot of innovation. It's a lot of copycat. And so we actually just removed all content from the greater internet for all practical purposes and kind of went into almost like a stealth mode as we kind of consumed that market. Today, we work with maybe almost 70% of the top 100 3PLs and large asset-based carriers. And we've done it all via word of mouth. And this doesn't mean that we won't advertise at some point or market at some point, but right now it's a lot easier to compete in the space when we're not creating our own competition.
Talk about, so there's, AVRL, automation technology at 4.0 scale. Over the course of the year, we identify 18 companies to work with us to automate their processes. Talk about what, how you came up with this. I mean, it could be 17, it could be 19, it could have been 21. What was the thought process behind this? I mean, this is the only line on the whole website.
It's a little fear mongering, to be honest. When you look at moving this bidding or this transactional freight into an automated process, if you don't do it, you die. And when we were looking at how we control contract volume, how we can control contract price, et cetera, it was to limit the number of entries that we could consume. And our approach is a lot different than a lot of startups. A lot of startups will go after small, medium-sized businesses and work their way up. When we came into the freight side, our first customer was JB Hunt. They, for all practical purposes, on the railroad. And what had happened was that Arkansas...
Just for people's, vantage point, JB Hunt, they did 3.15 billion in the fourth quarter of 2024 revenue. So that is a huge first client to get.
What had actually happened is we were working with Walmart and they had introduced me to JB Hunt. And that was this really interesting opportunity for us. We actually didn't know anything about freight. We had actually gone in to pitch JB Hunt this very unique use case that we thought that they would want. Spent a couple of days with them and they were like, actually, could you automate this other process for us? We went and learned it, deployed our technology to solve that challenge. And then we had another 3PL and asset-based carrier in Arkansas call us to do the exact same thing. One of the things that a lot of people don't know about the freight or logistics industry is it's super incestual. Every company basically spurred out of, 2 or 3 companies. And now there are, 20,000 freight brokers and 500,000 asset-based carriers. But really, they launched out of these small groups.
Talk about onboarding. This is the first client you get in this industry. It's a different industry from what you're used to. How did you redefine and configure your onboarding based on this type of client?
So I had gotten really lucky. Part of the reason why SAP was interested in us originally is we had built a custom browser. And when you look at how SAP was created, it was a closed environment where they didn't expose APIs, so you couldn't hook into it and extract data out of it. That also led to the opening and opportunity for Salesforce to come into that space. But part of our browser was to extract data out of a legacy ERP system so that we could do ETL on it. When we went and looked at what JB Hunt wanted is they wanted to run automation on the web, but you couldn't use robotic process automation because it's a third-party system that you don't own. And so any page change or XPath change would break RPA. What we did was we started just inserting HTML into the site. And when we were looking at the process, we actually didn't know how much opportunity there was, but it was probably like the 4th month in. Their head of data science was like, we were on a call like this, and he's like, hey, we need a new contract. We were like, why? This doesn't make sense. And he was like, well, you've already made us $11 million. And I looking at my co-founder in that tiny window in the corner, and I'm like, don't say anything right now. Like just get off the call as fast as possible so that we could come in and look at like what we were pricing, etc.
When he
And
was saying that, and he's like, let's redo the contract, he was saying, we want to pay you more.
yeah, he was saying that they wanted a longer term contract. We had done like an initial 6 month like proof of value. We've never done a contract we didn't charge for. I think it's like the biggest pitfall of any startup is doing anything for free. But they wanted a longer contract, and what we wanted to do is do value-based pricing on it.
Yeah. So how do you determine value-based pricing when they're like, you just made us 11 million? You're like, okay, we'll take two. I mean, I don't know.
We shooting in the dark. We're just we literally went in, internalized it, looked at like how far we were in the process and where we were going to go, and we pitched based off of that. They accepted it, which meant we priced wrong, right? It's like the worst thing to do, but I
guess part of it, but like you also, they're happy. You don't want to get too much pushback, but we always think, oh, I could have done more if they just accepted it right off the bat. But
yeah,
they're happy, I guess. Do you think, from a company like that, are they typically sharing that type of stuff with you? Hey, you saved us X amount, or
I don't think, no, I think the industry is really interesting because when you look at the freight brokerage side, these guys operate on like 2%, 4% NOR. And so there's not this yield, this massive yield that comes out of like 11 million bucks, right? They're probably running at like a 10% margin on it. And so when you look at these large companies, pricing is really important, like to maximize the contract value. We focus predominantly on yield, and yield extraction has to be like, I make them more revenue. We want to work with them to turn that revenue into margin, essentially.
Talk about we talked about the onboarding a little bit. I mean, this is very highly technical. When you built the team originally, what did that look like? And then I'd love to talk about how the team evolved over time, but talk about the team, and what you thought you needed to build in the beginning.
Yeah. So most people don't know this, but AVRL stands for Advanced Voice Research Labs. And my CTO had brought some technology out of Cornell that he had been working on that essentially is natural language processing, but it measured sentence length and then looked for conjunctions and inflections inside of text. And that's really hard to do because inflections do not live in text. But if you measure the sentence length, you could start to predict where mistranscriptions live inside of speech recognition. And Advanced Voice Research Labs was created solely because BMW wanted us to build their in-car voice tech. And our original team was all based off of that. As we started to look at, scaling and companies like SoundHound in the market at the same time as us, we were like, well, we're not going to be able to compete with Siri had just acquired some tech, or like Apple had just acquired some tech that turned into Siri, and SoundHound was booming. This is all 2017 when there was like so much NLP hype. We were like, let's go after the business application space, which is why like SAP was like super, super interested in it. And our team
How did you get in? Just to back up for 1 second, Jed, how did you even get into discussion with BMW?
Craziest situation. Flew to San Francisco. We met with like Ford, BMW, Volkswagen, Mercedes-Benz, all in one day. And we're like, we're going to pick one. We'll go exclusive on that specific contract for in-car voice tech for a certain amount of time. And it was whoever signed it first took it. And BMW signed our contract, no edits, which is wild.
That is wild.
It's super wild. But
what did the team look like then? I mean, it's like
I think that there were 12 of us at that time, and all engineering. I'm an engineer myself, and we for the longest time only had engineering. We weren't focused on like customer success. It was all just like brute force engineering work. As we kind of like transition from that in-car space into business application, we had to figure out like how do we build customer success. We felt like it was a waste of money because it's, some person who's basically a glorified project manager. We had to build like QA systems, etc. That's actually why we had gone to raise. But I think when we raised in 2017, we were doing 50K a month, like 50K a month in revenue. And that gave us like a far better terms than most people were getting in the market.
Yeah. And so what was the evolution of the teams? You started with 12 engineers.
Yeah. Oh my gosh. This was really interesting. I was living in Portland, Oregon at the time, and we were having a really hard time recruiting anybody. And I love Portland. I think it's a great place. But I think the startup scene is really difficult. There's just not talent there. There's not a ton of money there. The access to capital is really challenging. And so I was basically flying to San Francisco like every single week. And I ended up like, I don't know if you like remember San Francisco in like 2016, 2017. It was just like metropolis, like booming. Everyone had high energy, and I would fly back to Portland. I'd just see my energy die, like just die the moment I landed. And so I moved my team to Seattle. And we started hiring people in Seattle, mostly on the technology side. We really struggled. Like we would hire people from Microsoft. They would come in, not super hungry, like really kind of struggled that way. And so I started building a data science team in Toronto. And that's where our data science team is today. My CTO.
What were you looking for at the time? You found maybe someone out of corporate wasn't as hungry and scrappy of what you needed at that point. What did you find was a good fit?
I think that what we started doing was we would hire younger engineers, train that literally hadn't worked before, and come in and fully train them on like literally on spec of exactly what we wanted. And I think Seattle's also a hard market because you look at Amazon, you look at Microsoft, you look at Boeing, you look at Tableau. They have such great jobs, and their comp is super great, and their like 4-year like vesting like stock schedule that comes in as part of their comp every single year. Like the Seattle original like founders have built like massive machines to retain talent, and it also like stifles a lot of innovation, I think, in that city. But we were just looking for people who are hungry that would be willing to work, 24/7, 365. Like I think that's like what we were looking for. My CTO ended up moving. He's European. He left the US, went back to Portugal, ended up moving to Riga, Latvia, and we split our team completely. And so we had a really good friend living in Toronto, running that engineering team. Nikolai is living now in Latvia, building an engineering team there. And I was kind of running everything from Seattle.
So it starts with 12 engineers, then you grow the team. What's it look like?
I think we tried, like when we raised money in 2017, we raised $1 million. And then like maybe 6 months later, Fontenay partners called me and they were like, "You guys are killing it. We want to give you $1 million on uncapped safe, another one." And I called the rest of my investors. They were like, "Yeah, we're in." And I think that everyone was like, "Oh, they're going to like continue to raise." And I think that was the plan. And all of a sudden we started hitting profitability, and like the technology was starting to be successful. We were starting to self-fund R&D, and we're like, okay, well, maybe we don't need to raise just to raise money. We really feared how high the valuations were back then, like everyone should have. And so we ended up just literally starting to self-fund and pushing that money back into the company. We started to move more and more of our engineering resources offshore. It was like cheaper. I think Toronto is actually a fantastic place to build an engineering team. I think you can probably run like 60, 70 cents on the dollar and get really great talent. And so as we started to build this model, we started going like deeper into business applications, and we started to run like what we thought the Silicon Valley like tech platform was. We were working with like large Fortune 500 companies. So we brought in in-house counsel. That was an awful mistake. What we should have done was we probably should have gone and started working with smaller companies on our own paper rather than spending like a year in procurement with a company like a Home Depot. And so we were just like making all of the mistakes, started hiring customer success in case we hit like specific growth metrics. And as we started to push towards like 2020, the market really kind of like fell off. And we stripped, I think we were probably around like 60 people and we stripped it back down to like 20, like buttoned up the hatches because we thought that COVID was going to be really atrocious and awful for business. And it was. But at that same time is right when we entered freight. And
I
the
was like, freight
freight
was
market,
probably going ballistic then.
I think like right now you're seeing volume being traded at, dollar a mile. Then it was trading at $6, $7, $8 a mile. And that's like a really, really crazy concept. The freight market's booming, capacities doesn't exist. And so freight trades in a very interesting way, which is they don't trade shipments, they trade trucks on the road. And the more trucks on the road, the less the freight trades for. The least amount of trucks, the more it trades for because you're essentially trading capacity. And this spikes in our business. I think we literally went from like, I don't know, 2 million to 7 million in a year. Like, like it was like this crazy shot. And we scaled that team up almost to 100 people and mostly engineering. Since then, we've obviously been building our own innovation. We're using like AI applications for our own internal use so that we can streamline engineering, et cetera. I think our engineering team's right around like 65, 70 people right now. But it's been like a super roller coaster with that team. We were caught in a trap that a lot of startups get caught on, which is like, how do you continue to grow without hiring engineering? And when the freight market took an absolute nosedive. So essentially what had happened was PPE loans flooded the market. Freight is like the American great like industry, right? So then everyone's buying trucks and putting that money from the PPE loans back into the market. And what ended up happening was they ended up collapsing the market because they brought in too much capacity into the market. And that I think has been a struggle since probably end of 2020. Yeah, probably about 2022, they've been like really like facing a pretty wild situation.
From from any SaaS company, once someone hits like a product market fit, it's magical. I do want to fast forward through some of the niches that you did before you landed on
Yeah.
freight. I know that you did some oil and gas. Like just fast forward some of the you didn't just land on freight and logistics. Talk through some of those.
Yeah, it's really interesting. So when we turned focus towards business applications, we saw the world where people didn't use tablets the way that they use them today or smartphones the way that you use them today. That same time, the Uberization of everything is really happening. And so when you look at, someone picking like groceries in the grocery store and they're scanning items, we went after applications where, you're talking to a headset, it's communicating directly with the device. We started working with auto manufacturers on their bill of materials, on their maintenance products, et cetera. I think that maintenance was probably where we ended up spending a large majority of our time doing 360 inspections, where you're talking to your device and it's piping all of that data into the maintenance database and then auto ordering the parts. And so we were doing the automation on the backside of the NLP. I think a lot of people like in the industry don't understand the difference between speech recognition and natural language processing, but we would take like the speech to text and then go process all of the data. We really like started to find niche in that maintenance side, which is how we had met Walmart. And at the same time, we were starting to see this massive traction on oil and gas. Oil and gas actually wasn't in the field. It was on the brokerage side. So most oil and gas brokers or traders, they trade on this system called Intercontinental Exchange or ICE. And what they have to do is, ExxonMobil will trade swaps with BP on a well, and they have to manually type these really crazy codes into their ERP system. So you have these traders that are making, $3-4 million bucks a year that are literally manually typing these transcripts at the end of the day into their ERP so that they can process the order and execute it. What we were doing was you were using our NLP to read the chat and pipe that data directly into the ERP. It was like super successful. It's actually what started to get us to look at the brokerage industry in general.
And then that led you to JB Hunt.
So it was actually Walmart led us. They were using our systems for maintenance applications in their truck facilities, and they were our first like real transportation customer.
Yeah, so I can see, I mean, it's a crazy journey from a niche perspective, from like B2C to B2B, and then kind of going from auto, CPG, oil and gas, Walmart, brokerage, and freight. Um, one of the things that I was reading one of your LinkedIn posts, it says founders aren't shaped by wins, right?
Yeah.
They're shaped by failed things, issues, challenges. So I know you mentioned, along the journey, in-house counsel, going back, you would have not done that. Hiring, customer success. Like, what are some of the things along the journey that stick out to you that allowed you to get to where you are because of that adversity?
There's so much.
We'll talk about today, just today. No,
I got trapped in a couple of things. Like one, I was attracted by big logos, and I think that a lot of startup founders get trapped into this like big logo mechanism. Like, right, they want to work with the Exxon, they want to work with the Walmart, they want to work with the Walgreens. The challenge with that is that those companies want to work on their paper. They have massive legal teams. It take forever to pay. They're use like massive payment processing systems, and those terms override their MSA terms. And so you get trapped in this like massive legal battle. Fast forward today, like you want to work with AVRL, you sign our paper. And if you don't want to sign our paper, then we're probably not going to work with you. And I think that that was a huge learning lesson for me. I think on the team side, we got trapped into hiring teammates rather than focusing on building processes and scalable systems. I look at my team today and we've almost fully automated our customer success, right? Like just like you supported AVRL.io, it's going to go literally through an LLM model that's going to get piped directly to my product owner. Like we don't like, and I didn't think about that before. I would put some person named Alex in front of the customer, and it would take 3 times as long, and the customer would get frustrated and we would get frustrated. But that's how we looked at like Silicon Valley, is that everyone was hiring these traditional SaaS, software as a service customer success people, which were literally glorified like punching bags for the customer, right? And so we were just focused on the wrong things completely, like constantly.
Yeah. I mean, in fairness, they probably don't have the same development skill set that you do. So, I'm sure some of these things you've created internally could be its own product. I mean,
for sure.
What you created there, and that's kind of the blessing and the curse, because there's so much stuff that you could do, which you kind of see through all these niches. Like you can go into any business and help it, but which one do you choose? And then you're building these things internally too you could probably release that as a separate product. People, lots of companies would be like, wait, I don't need all these customer support people. You could pipe it in and then it, spits out, answering the questions.
Yeah. I think we fell into this common trap that a lot of AI companies are in right now, which is like, you have this tech and now you're trying to find the application for the tech rather than this search for the problem and then build tech to solve the problem. And if I ever went and built a company again, which likely will probably happen at some point, I would be in search for the problem. And I think that that's what makes like really great entrepreneurs great, is they're building for a problem, not building for tech and then trying to find the application.
Talk about, I know you raised money and as you're growing, but we were talking before you hit record and you said the founding team owns 100%. Those things in my mind kind of clash and don't register.
Yeah. I was living like this Silicon Valley like dream when we were starting AVRL. I was going to raise a price round. We were going to raise it from like really, really big venture capital. We weren't looking at it's like play as like money is fungible, find the cheapest money. And I'll give Mike Greenberg credit. I don't know if he'll watch this, but I have a buddy that lives in Santa Monica, and I was in San Francisco, and I was getting ready to close a round, and it was a price round. He's like, "Come down, hang out with me for the weekend." And he had just sold a company, and I'm showing him like what we're working on and where we're going. And he's like, "Dude, um, don't raise a price round, raise a safe." And I'm like, "What is a safe?" And he like walks me through a safe, and we flipped the deal on to a safe, and we closed it maybe within like, I don't know, a week. And this was back when safes were really becoming like like an interesting mechanism.
Talk about that for a second. The safe.
Yeah. Safe is, so a lot of people will raise like a convertible debt or a convertible note during their like, for like really, really early seed. And it essentially would be a certain amount of money that you either pay back or the investor takes a certain portion of the equity. And it usually comes with a discount, but there's always a maturity date on that. So at a certain time, a safe doesn't have a maturity date. And it's essentially an option to participate in future funding at a priced round. And what happens if you don't ever convert it because you never raise a priced round is that you hold that safe, and it's just essentially an outstanding liability that needs to be paid out at some point in time.
And there's like a fixed like interest rate or something like that on there, or?
Yeah, there's usually like a discount that's based off of that. Or a cap. So you could have like a safe that has like a 10 cap. So the discount comes, post 10.
And investors don't typically want to do that because they're like, we're risking our money. We want upside.
I think it's interesting. I think that it's Y Combinator created the safe, and it's still the mechanism that those companies use today. However, what Y Combinator does a really great job of is that post their program, they put you in front of a bunch of investors to raise an equity round or some type of instrument. We didn't have that, and maybe we will convert them at some point. I don't necessarily know today, but we were really like creating great business. I started spending a lot of time with a guy in Seattle named John Connors. He's on the board at Nike. I can't remember what their firm was called. It's called Fuse Venture Partners now. But he had me meet with his lawyer, and I was showing him our tech, and the lawyer was like, "Hey, did you come from a lot of money?" I was like, "No." He's like, "Have you like ever like sold a company before?" I was like, "No." And he was like, "Okay, focus on base hit. Like, don't focus on the grand slam right now." And I literally left that meeting like, okay, protect equity, hit a double, hit a triple, hit a base hit, like whatever, just get on the map and then go and figure it out later. And we were probably pretty close to running, like needing to raise, and Fontanales Partners called me and offered me an uncapped safe again. And I think that my other investors got really pissed, and they wanted to participate as well. And so we ended up raising another $1.5 million. And that's ultimately like what led us to profitability. And since then, we've just been self-funding our R&D.
I love it. Chad, talk about mentors for a second. You talk about John Connors, you talked about your friend from Santa Monica, and these are pivotal advice and things. Who are some other mentors? It could be colleagues in the industry who've just given you some good advice or lessons along the way.
Yeah. This is super interesting. And I don't know if other founders have this experience, but some of my customers today are some of my best friends, which is a really wild thing for a founder to experience, is that I'm helping my customers make money. And maybe that's why they want to be my friend. But, I've literally gone to Aruba with a customer. I've gone to really interesting places with them. I go to College World Series with a customer every year for fun. My wife comes and their kids come, But some of my mentors now are customers that I work with like really, really closely. There's some guys in Omaha, Ayo and like Tom, they run a company called Kirsch Transportation. Matt owns that company. It's just great people. Russell White, Paul Transportation or Paul Logistics. He taught me something that I had never been taught before that I literally use in almost all of my meetings, which is like an IT team and a vendor. Like when they talk to one another, that discussion is either going to bring them closer together or push them further apart. And I've never thought about that from a vendor perspective before, but we have to think about what is the outcome of this. And yeah, so there are some companies that we don't want to work with and that we do want to push apart, and we treat them like we treat that conversation in a different demeanor than others. The guys at Echo Global Logistics, like Jay, Scott, Zach, some of my like really great friends that are also like mentors to me. But what these people have done in transportation is they've introduced me to some of the most important people, and they've really been pivotal in the success of AVRL from the standpoint of they saw that what we were doing, they believed in it. One, they believed in the vision of where we were going, but two, like they were seeing the benefits of it. And in like a fairly incestual market like that, I think that what the logistics companies either do is they push you out or they like bring you in. I really feel like we've been brought in as an organization.
I want to talk about, I mean, there's so many moving pieces in this industry, and like what you do pulls a lot of these pieces together, and it's just a hard thing. So I want to talk about, I mean, right now in this point in time, there's port wars and tariffs. So I want to talk about that. I do want to just point out one thing. You mentioned Echo Global Logistics. I would have no idea who that is or what that is. But the funny thing is, so my background is a former recovering chiropractor and in Chicago, and so we were one of the first deals that ran on Groupon. Okay, in my office. And I had all these people coming from Echo Global Logistics. I'm like, how is this? Like, why is everyone from Echo Global Logistics? Well, I guess I didn't realize that Eric Lefkowski and Bradley Keywell, but Eric Lefkowski was one of the people that brought Groupon to market. And so they ran it at all their big companies. And so I got a flood of people, and I was like learning about logistics because of the patients that were coming in from that. So it was remarkable, some of the stuff they were doing there. So just funny small world. But talk about tariffs and port wars for a second, and how this relates to making your job harder.
Yeah. When you look at the current environment, I mean, the 3PLs and carriers have seen so much rate compression over the past 3 years, where the shippers will continue to take volume to bid. They'll take on the RFP contractual side, they'll keep like literally, usually they'll use like one RFP for a year or for 6 months. But what they'll do is they'll continue to whittle carriers and 3PLs down to drive the rates really low. And right now you have the rates are at almost like pre-COVID level. And that's like a really interesting concept because the market moves in a very cyclical nature. And right before COVID was a down cycle in 2019. And so the market moves like a traditional like cyclical market, but with all the PPE like money that entered and how the ports were so backed up in COVID, it drove rates through the roof to a level that no one had ever seen before. And so clearly your cyclical market's going to be like, it's going to take a lot longer to go down. What the industry needs for rates to go back up is they actually do need 3PLs and carriers to either get consolidated, so purchased. They need capacity to leave the market. So you need 3PLs or carriers to go out of business, which has been happening like hundreds per day. And when you look at what's happening with the ports and with tariffs, there's two things that are happening. One, volume is being like it's not coming into the United States. And I don't actually know how much of domestic transportation runs on international volume. But when you look at things that get manufactured either in the United States, like let's say a home or commercial real estate, et cetera, that steel comes in from China. It comes in from other places. And what we're seeing right now is we're seeing almost no ships enter the market, where companies are just in a holding pattern to see what ends up shaking out. I was with Red Flyer. Do you know that the little wagon company?
Oh yeah, sure.
And I have a friend that works there, and he was talking about, what they were doing is they used to manufacture in China. They moved that manufacturing to Sri Lanka. because that's where they thought they were going to manufacture. Tariff hit Sri Lanka. So then they froze and they're like, we'll just stop manufacturing for right now. As you see, I think there's probably like 59 ships or 96, I think it's 96 ships that are hovering around in the ocean around Seattle. They're being rerouted to Canada. And what they're going to try and do is avoid tariffs in the United States. And so what there's this fear of is that volume gets unloaded in Canada and then it gets trucked down to avoid, or there's another theory where volume arrives in Canada, it lands in Canada, and it just sits there and no one claims it because you don't have to pay the tariff until you claim ownership of the property. And so I think that we're really near COVID level of actual vessels in transit or at ports. At the same exact time, I think there's negotiations with the ports, and that's an interesting thing. I think that there's a lot of people in the industry who are not sure what's going to happen. Vessels that come into the West Coast, you have a port in Seattle, port in San Francisco, port in Long Beach, and it wouldn't surprise a lot of people in the industry if they just stopped coming into Seattle and into San Francisco, and they arrived in Long Beach, and then they transported that on a different mode via train, could be via a domestic truckload to those markets. The really awful thing about that is that if you live in Seattle and your port's not utilized, volume of product is going to be really difficult, one, but then you're going to definitely get the price inflection of that transportation cost that's going to come in. And so I think the entire industry right now is really frozen and just waiting to see what happens. At that same exact time, the freight brokers and asset-based carriers don't have like volume to move. Rates are really depleted. Drayage will definitely get crushed. Drayage is the mechanism that takes volume from a port to a distribution center, maybe like a 100-mile run. They expect massive bankruptcies in those markets. There's just not any volume. There's super bad margin compression. Plus, you're talking about an industry that operates at 4 or 5% already.
I mean, talk about the ripple effect. You know what I mean? I'm going to just really quickly, if anyone at this point in time or whatever is like, what do the tariffs mean? And we were talking about this before we hit record, Chad. It's actually my brother-in-law, Brent Nyman, who's an economics professor at University of Chicago. He's on, he's been talking about this, and he puts it in a way I can actually understand of what's going on. And so here's one, him on CNN. There's a bunch out there of him on various news channels. So if you search Brent Nyman, you'll see MSNBC, CNN, or wherever, and he just kind of breaks down what it means and kind of how it affects things, because he did specific research on this, because that's what he does. So people can check that out. Chad, last question. First of all, thanks for sharing your journey, your stories. It's amazing. If, I usually point people to someone's website, but there's not, you can go to avrl.io and there's a number, or you could email them if this is of interest. But he does post a lot on LinkedIn, so you can also check out his LinkedIn musings as well. My last question is just about leadership and post-child and pre-child leadership. And I find this to be an interesting topic, and just talk about maybe pre-child leadership and post-child.
Yeah. So for those out there that don't know, I had a child on New Year's Eve. She was 6 weeks early, and that was like really an interesting situation. And I wasn't sure, and my wife's the same. Like if we wanted to have children, AVRL is kind of my baby, and I've been working on it for almost a decade. Pre-child leadership, I have almost like zero empathy, just in general. And I think that when we looked at recruiting, when we looked at that, we were so focused on hiring people who were motivated by money, because money's like something that we can control, even if we're going to work 24/7, 365. Post-child, Chad, is really interesting because I just feel like I'm a lot more empathetic towards my employees' needs. I still work most of the time that I'm alive. But I'm starting to understand the need for work-life balance for other people and them wanting to spend time with their family and the reward that they get out of that and taking vacation, etc. And so I would just say that that's been a personal transformation for me that I've been talking to some of my friends about, that I don't know if you get to experience unless you actually do have children.
Yeah. Chad, first of all, thank you. Everyone check out AVRL. I don't typically do this on the interview, but I'm going to do it this time because I find it fascinating. I have a special self-proclaimed talent where I could spot celebrity lookalikes. Okay. And sometimes it just comes to me. And for some reason, in the middle of this interview, I'm like, Chad has a celebrity lookalike.
Oh,
Yeah, I'm going to pull it up so people who listen or watch this could agree or disagree. And I don't know if you get a celebrity lookalike. Do you?
No,
No,
but
okay.
I'm excited.
Okay. You'll ask your wife. Your wife will be the true test. If people don't follow basketball, JJ Redick. You could take a look, see if actually you agree with me or not. That's my Chad celebrity lookalike for today.
I'll take that. I think that's good. I'll take that.
Yeah. Yeah. So, anyways, everyone, thank you. We'll see you next time. Chad, thanks so much.
Thank you.
What I got, you can't buy. It resides between my eyes. Walked through the fire, came out better on the other side. See, life's like a beach if you find the sailing right now. I'm feeling like 100 grand.